Today I would like to take a look at Alphabet, also known as the owner of Google and YouTube. They have many other business units as well. And when we look at the stock price, we can see for the 1 month, we are down close to 10%. And the 5-year charts, we are still up significant, close to 190%. So today I would like to take a look at the financials to find out if this company is a good buy right now or is it overvalued. So the first thing we can recognize about this company is a huge market cap of over $2,000 billion. So this can mean in the future it will be more difficult to grow as a business. We can also see they have a dividend of 0.49%. So it's not very huge, but probably it will grow in the future as well. Now we're going to take a look at the financial foundation. The first thing we are looking for is revenue growth over the last 5 years, because we want to invest in a growing business and not a declining business. So we can see here in 2019 it was $161 billion. And now in 2023 it's close to $307 billion. So it's a big growth over the years. It's nearly doubled. And this is something we really like to see. So it's a check here. Now we're going to take a look at the free cash flow growth. This is a very important number because the free cash flow is used to pay the dividend or to buy back their own shares. So we want this to grow over the last 5 years. If we take a look here, we can see in 2019 it was close to $31 billion US. And now in 2023 it's close to $70 billion US. So we have a significant growth. It's over doubled, and this is really great to see. So it's a check here as well. Now we're going to take a look at the free cash flow yield. We would like to see that over 4%. This can also tell us about the valuation of this company. So if it's under 4%, it could mean the company is overvalued. So now we're going to take the free cash flow from 2023. It's 69.5. And we're going to divide it with the market cap of 2000. And then we're going to get the free cash flow yield. So we get 0.03475. This means we have 3.475% free cash flow yield. So it's under 4%. It's not a check here, but it's not looking too bad. It's not the crazy difference. Now we would like to see the debt to free cash flow ratio under 5. This means the company can pay back the debt with the free cash flow in under 5 years. So it's a very important number, because if a company has too much debt, it could also risk to go bankrupt. So we don't like to see that. And we're gonna take now the short-term debt. It's over $4 billion. And we're gonna add the long-term debt as well, over $25.71 billion. And then we're going to divide it with the free cash flow that we already had. So we're going to get the debt to free cash flow ratio. So what we get is 0.4296. So in under 1 year, we can pay back the debt with our free cash flow. So this is an amazing number, actually. It's a check here. We can also take a look at the cash on hand, so how much money the company has in the bank. So we see here it's over 110 billion US dollar. So this is amazing as well. So they can pay back the debt already with this money in the bank, or they can invest more in the business, or to pay the dividend, or to buy back their own shares. So it's something we really like to see. The last thing we are looking for is shares outstanding decrease. So this means that the company buys back their own shares, and we would like to see that, especially if we think the company is undervalued. So now we're going to take a look at the Alphabet shares outstanding, and we can see since 2017, every year they did buy back their own shares, and in a big number as well. So it's a check here. And this can also mean when they buy back their own shares that the stock price increase because less shares are available to buy. I would like to give my conclusion about this company. So let's start with the positive things. They have a strong market position, so every day many people using their products. They have great financials as well. They have the growing revenue, the growing free cash flow, and they also have a great balance sheet, they have less debt, they have a lot of cash on hand, which they can use to invest in the business or to buy back their own shares or to pay the dividend as well. The negative would be the regulatory risk question mark. So we don't know if this company gets too big, that there could be the regulatory risk from the government. And also the question is about the valuation. So maybe this company is overpriced right now, but everybody has to decide that for themselves. So I hope you enjoyed this video, and please leave a like and subscribe to support this channel.